Okay, Duncan, how are you? How are you holding
Good.
up?
How are you doing? Doing well, considering the situation.
Yeah, do you have kids or you going insane or is it pretty mellow?
Got a 4-month-old, and he's making the shelter at home so much more enjoyable. He's awesome.
I'm sure my 4-year-old is 4 months. I'd say that's a bit more challenging, actually.
He's a challenge, but he's awesome. He makes it makes time fly by so fast.
That's true. Wow, congratulations. I didn't know that.
Thanks. Yeah,
Well,
he's
I'll
awesome.
jump in here real quick to just a little bit about you. What is your full name? You're the owner and company. So how long you been a loan officer? What's your background?
My full name is Duncan Hsia. I've been in the mortgage business for 8 years. I have a business degree from Wharton Business School. I have an engineering degree from the University of Pennsylvania. So I was in a dual degree program, wasn't sure which way to go. I ended up staying with both. I ended up working as a consultant for Anderson Consulting for a few years, worked in California and in Paris for a year for
Oh,
Anderson.
wow.
And then I came back to California and I started working for a company called PeopleSoft, and I managed it was a company based in the East Bay in the Bay Area, and I managed their services, their consulting group in the Western region, and I was the manager of the account management group, so customer service and technology. And then that really gave me a good background for the mortgage business. Coming back to Hawaii, there's not a lot of tech business here. And so the mortgage business is one of the few businesses where you can do as well as on the mainland, with the home values here very similar to California. So it's something that made a lot of sense because I like working with numbers, like working with people and customer service. So it's something that worked real well. I also, in between, I kind of, when I left PeopleSoft, I was working here for PeopleSoft for a little while, but they ended up restructuring, and I was trying to work remotely. I contracted back with them for a little while, but then I ended up just going on my own as a trader and investor. And so I've got a lot of experience in the financial markets too from that background. And I was looking to start a hedge fund with a partner, but the infrastructure for what we were going to do, automated trading of futures and ETFs, this infrastructure wasn't set up for a small business like ours. So we put that on hold and got into the mortgage business, and the rest is history. And I started my own company last year and got 4 loan officers, hired an operations manager last month. So we're looking to grow and got a great team of people.
You hear that? People looking to grow in the middle of this pandemic. So you're a sharp guy. I'm glad to hear that you're doing well. I expected nothing less.
Yeah, we're doing great. Thanks.
Thanks. That was a lot of background. I actually never asked. So good information. Okay, we'll dive into the lending questions because that's what people are really curious about, and myself. Okay. Overall, in a really just broad scope, short paragraph, what changes are you seeing in the lending market?
The biggest changes we've seen are in the non-QM market, which is loans that don't fit in the normal conventional or VA or USDA or FHA type of loan. They don't fit in the normal boxes, and not even jumbo. But we would do loans. I just closed one right before all this happened, where it was investors in an LLC. They bought a place where the whole financing was based on the potential rental income for the property. And so they didn't have to show any documentation for income. So it was purely based on the potential rent income from the property. That market has really dried up. There are still some lenders that will do those. We still can do those types of loans, but a lot of lenders have left that market. Some lenders have gone out of business from that market, and some have just suspended that market. And so that's really where I've had some borrowers that were interested in that type of loan. I told them that we can't do them now, or we can, but not at the lower down payment amounts that people were looking for. The ones that still remain in that market, they really tightened up on their rules. So you can do it if you have a big down payment, and you have a very strong debt to service coverage ratio, or you have high income expected from the rents. So that market is probably the market that's tightened up the most, because a lot of people aren't paying their rents, and so when you have rents that are not being paid, that makes it real difficult to use the rental income for qualifying. Right. So that's the biggest change. Other markets, other types of loans have been affected not nearly as much. And there are lenders that have stopped lending in certain types of loans. Some have stopped lending completely. So it varies by lender.
So with that, what changes are in your underwriting process? I know that I know one, but I didn't know if you could let others know one or more major changes that a borrower can see through the underwriting process that maybe they need to provide prior if they're an experienced borrower, they're used to the process.
The biggest changes have to do with rental income. So if you're somebody who has rental income as part of your qualifying income, a lot of lenders are requiring additional reserves, additional 6 months of what they normally would require for reserves. And they want to make sure that you have the reserves in case your renters don't pay, because a lot of renters aren't paying their rent now. So that's one of the biggest changes. We also are seeing some lenders tightening up on their credit score requirements, requiring higher credit scores, tightening up on their debt to income ratios, especially if you have a lower credit score. Some are requiring more reserves. They just want to see that you're going to be able to pay the mortgage back.
Sorry to cut you off. Can you be a little more specific on what types of loans they're increasing and looking for higher credit scores and lower debt to income? Is that your traditional 5%, your FHAs, your VAs?
Yeah, it depends on the lender. I've seen a lot on FHA. FHA, we used to be able to do a lot of loans in even the upper 500s on FICO scores. Some lenders are requiring at least 680, but it varies depending on the lender. And we work with a lot of different lenders, and it's not across the board. It's all the same. It varies. And so that's why it's good to work with a broker that works with a lot of different lenders. If I were working at one specific lender that had tight rules, I'd be stuck, and it would be a lot harder. But when you can go to a lot of different lenders, then you can go to the ones that aren't as tight on the rules that apply to you. So it's good to have that flexibility. Another big change that we've seen is with a lot of people losing their jobs or going on furlough, lenders are requiring them to do a verification of employment the day before funding. So right at funding, they want to make sure that you still have that job. So they don't want someone to lose their job and not be able to make their first mortgage payment. And so that's including, in addition to having the reserves, they want to verify that you still have your job that you have on your application. And a lot of lenders are requiring you to sign attestations at closing to make sure that everything in your application still applies, that you haven't lost your job or you haven't taken on new debt or haven't missed any mortgages on any mortgage payments. So that's something that some people, the government makes it seem like you can take a forbearance or deferral on a mortgage payment. That can affect you qualifying for a loan. So if you have a rental property that you decide you want to do a forbearance, that can affect you if you're trying to buy a place and you say, okay, I want to go into forbearance in this. They think you're not going to lose anything, but you actually are. It is something that can affect your qualification for a purchase. So be very careful before you. Yeah, so be very careful before you decide to accept any forbearance or modification. That will actually, they said that it wasn't going to show up in your credit report, but Fannie Mae came out with a restatement of that guidance last week saying that they are going to actually report it to the credit bureaus. It's not going to show up as a missed payment, but it is going to show up, or it won't show up as a late payment, but it will show up. So that is something that can affect you. So be very careful before you do accept to do any forbearance or deferrals, because it can affect your borrowing capability.
So, and to sum up that sort of topic, you guys are still able to do all of your standard conventional 5% loans and up, your FHAs, your VAs. What you're really limited on, you're seeing dry up, is the more creative loans for the investors.
And sometimes self-employment underwriters are requiring either excess reserves or decreasing the in self-employment income by 25%. So it's tougher for self-employed or investors to qualify unless you have a lot of reserves and strong credit, and all the different factors will play in your loan-to-value ratio. So if you're very leveraged and you don't have much as far as reserves, and you have bad credit, then it's harder to get a loan than before. But for most loans, we're able to do. Some lenders we're not be able to do them at the same rates as we were before. The rates is another thing. It varies quite a bit between lenders. Some lenders that we used to work with a lot, they have their rates a lot higher now. They're trying to decrease the volume, lower their risk in this environment. They tell us it's temporary, so we may go back to them later on, but we're going with a lot of other lenders that we don't work with normally, but they have, in this environment, they have the best rates. And so we're having to adapt and use lenders that work better in the current environment for our borrowers.
Again, a pro to being a broker, because that leads into my next question is, right now, what's going on with the interest rates? For the average credit score, for stable income, non-self-employed, non-investor, what are you seeing right now today? Which, if anyone doesn't know, interest rates fluctuate daily based off of the market. What are you seeing today when the market opened?
Rates are great now. They're near all-time lows, and on conventional and jumbo loans, we're having borrowers in the low threes, and if they're willing to pay any points, we can get even lower than that. On VA, we can get into the higher twos. Most of our loans we're closing are in the low threes or upper twos, so it's amazing rates for 30-year fixed loans.
What about refis?
Refis in the same range generally. Some lenders are adding, because the refi secondary market or the investors in some loans have really pulled back because a lot of mortgages, mortgage payers are going into forbearance, not paying their mortgages. Then there are fewer investors in the secondary market. So a lot more lenders are cutting back on the refis that they're doing, and some are adding additional points to refis. So it's a little bit higher on some refis than it has been in the past, but still great rates, still much better than historically.
I know. I'm gonna be refinancing my house.
Great. Yeah.
So you're still seeing jumbo loan interest rates in the low threes?
Yeah.
Okay.
Yeah, but jumbos, we always here in Hawaii have had, or as far as I remember, we've always had better rates on jumbos because it's pretty competitive with the banks here. So we've had better rates on jumbos than the national lenders. We've seen the national lenders pretty much dry up on the jumbo market, but they've always been higher than here. So we haven't been affected too much here in the Hawaii market for jumbos.
Well, that's actually my question. I know you mentioned that. So right now with jumbo loans here on Oahu, FHA and VA are $721,000, $50,000, and for conventional $756,000, $600,000. $756,000, $600,000.
$765,000, $600,000. Yeah.
Thank you. Are you finding underwriters tightening up for those jumbo loans, or meaning our borrowers having a more difficult time qualifying for them?
No, we haven't seen them. Jumbo underwriting generally is a little stricter than a conventional loan. It varies by institution. And jumbo loans, the underwriting guidelines are written by their portfolio loans. So they're not sold on a secondary market. So the guidelines are set by the banks that do them. And so we haven't seen real tightening up on them. Maybe a little bit fewer on exceptions, and they're tighter to make sure that you have the reserves, that you have the credit score. So I think the credit score and the reserves are maybe looked at a little more strictly, but in general, it's pretty much the same because it's always been pretty strict on jumbos. When you have the higher dollar amounts, the banks tend to be strict and want to make sure that you can qualify, and it's a big risk for them. It's a big loan amount. They want to make sure that they can be paid.
And we have a high price point on Oahu also.
Yeah.
So not to fear for those who are looking to qualify for loans. I know that that's sort of a big topic for the mainland borrowers and realtors. As a lender, what is your average timeline on closing right now? Are you seeing and experiencing any delays with the stay-at-home orders?
We have seen some delays on appraisals. I actually had an appraiser just went AWOL recently, and we were worried about whether he got COVID. So we don't know. The borrower called him. He was scheduled to finish his appraisal, and he said, "I'll have it to you by Wednesday." And Wednesday came, no answer, no appraisal. A week we waited for a response from him. Nothing happened. So we transferred it to another appraiser, and we were able to get another appraiser to do a drive-by appraisal, and we were able to close. That was on a refi, so it was we had to extend, but we covered that. The borrower was super happy. He got I think he was right at 2.875 and a 30-year fix. So he was real happy that we were able to close, and we just closed yesterday. So that ended up taking probably a little over 30 days, whereas we were pretty consistently under 30 days on refis before all this happened. We can still do loans another under 30 days. Closed one yesterday that was a little over 3 weeks on a purchase. They were going against another buyer who was offering 10,000 more, but they were saying it's going to take at least 60 days. So the agent asked, "Can you close in a lot faster?" I said, "Yeah, we can close a lot faster, even in this current environment." And we closed in less than 3.5 weeks. So we can close fast still. We were delayed on that particular transaction. The title report took extra long because title companies are getting bombarded.
So sorry.
That's okay. We were delayed on that closing by the title reports. We did a rush on the appraisal, and we were delayed on the insurance because we were going to try to close early, but the insurance binder, they didn't get the change in time. So we couldn't close early, but we did close on time on the short escrow. So we can close under 30 days on purchases and refis, but it depends on the lender we work with. Sometimes a lender, if you want to go with a lender with the absolute best rates, sometimes they can be a little busier and they can take closer to 45. So generally under 30, but sometimes can be closer to 45, but we can still do standard 45-day escrows, and purchases usually 30 as well.
Awesome. Yeah, I'm experiencing the same thing with us too. We got 4 under contract around the same time, and 2 out of them were able to close in less than 30 days, and the others were, saying 45 to 60. So I think it definitely matters who you're using. I know you guys
depends on the appraisal. That's usually the longest thing, and these days appraisers are taking a little bit longer than normal. And sometimes we'll get an appraisal waiver, or we can do a drive-by appraisal. So it really depends on the transaction, the appraisal, and some other things that might come up. But generally, it's not too much different from normal.
So no one has a crystal ball, of course, but based on the trends that you're seeing so far and your research, what you're just hearing, do you think that the lending will only get more strict, or do you think that it will loosen up as the second quarter comes?
No, I think there are a lot of lenders that have put in temporary restrictions, and some lenders, they have to, when they lock loans, they have to hedge, and a lot of lenders got squeezed on the hedging, and that caused a lot of losses, especially as the government came in and they announced they were buying some mortgage-backed securities. So that caused some losses from a lot of lenders when the government came in and buying the mortgage-backed securities were rallying, meaning rates generally would be lower on mortgages. But a lot of lenders got hurt by that because they had short positions for hedges on loans. And when borrowers don't close on those loans, then they can suffer big losses. So some of the recent changes too is some lenders are not locking up front. Some lenders say you got to lock after you can only lock for after you get your loan approved or after you get your appraisal. And so that's one of the changes I didn't mention is the lock restrictions on buyers. Not the lenders that we usually work with, but some lenders are definitely not letting you lock up front because that gives them more exposure. When they do a lock up front, have to hedge, and the market has volatility. But I think all the things that most of the conditions they're putting in are temporary. So I don't see things getting tighter, but I see them loosening back up where they'll remove some of those or loosen some of those restrictions as the market returns more to normal. We're still in a situation where some lenders are having these losses from the short squeezes on their hedges, or they're having people not pay their mortgages from their forbearances. But the government has stepped in on the FHA and VA loans. Ginnie Mae, they're extending credit for servicers so they can have the liquidity so they can cover their losses. So that's kind of a temporary situation there. Fannie and Freddie, they haven't done that yet, but there are lobbyists that are pushing to do that. And so the worst case, you might see some services go out of business, and you might have more of the large servicers still around, but you're still going to have the market, and the restrictions are probably going to be going away as the market returns to normal. And most of these are temporary, and especially if we can get back to normal in certain parts of the country, relatively normal, then you're going to see things not so tightened up. So I think it'll only get better from here. And I think the mortgage lenders, if you look at the spread between mortgage-backed securities and 10-year treasury, traditionally, historically, they've been tied pretty closely. But when this all started, 10-year treasury took a dive and mortgage-backed securities, actually the rates went up. So in early March, the rates actually went up on mortgages when the Fed announced the 0% rates. And that 0% is just short-term Fed funds rate. So it's not the same as 30-year fixed mortgages. And so at that time, you saw mortgage rates actually shoot way up while the 10-year treasury went way down. And that was a result of those losses that lenders were having. And they also had a huge amount of volume because before all this happened, mortgage rates hit their historic lows. So you had a huge pipeline of refis, and lenders didn't want to take on a lot of new business. So they kept their rates high, and they had to because of those losses they were suffering in other areas. So we had rates a lot higher than expected, and you still have rates higher than what you normally would see if you look at the 10-year treasury as the benchmark. So if that spread returns to normal, you should see mortgage rates over the next few months. They should return to, they should at least stay at low levels. And if they return to normal relative to the 10-year treasury, as long as the 10-year treasury rates stay low, you're likely to see mortgage rates drop slightly as the months go by.
Yeah, I think a lot of this, the unemployment numbers, it scares a lot of people. And I think people are going to expect the market to sort of follow after these unemployment, but a lot of it's temporary, and just the opportunities have shifted, and these numbers are going to be really high for right now until a lot of these businesses bring them back. You know, even some of my own family, they were put on furlough for 1 week out of 4. So they get to file for unemployment just for the 1 week. So those all count to the tally of unemployment. And I mean, let's not forget, like historically in 1992 to 1993, when unemployment rose, the home sales increased. And the same thing with 2001 to 2003. Unemployment rose and home sales increased. Now, home sales.
Yeah, if you look at the last, I think the last 4 or 5 recessions, the only recession where home prices decreased was this last one, where it was the housing prices. So housing prices in this current environment where you have such low inventory, it's as long as the economy doesn't completely falter, I think things are probably gradually get back to not quite normal. We'll probably have some things that will be changed for quite a while with the distancing, but I think we're going to see things gradually return more to normal, and the restrictions that we've seen on the lending market gradually loosened.
I agree. Thank you, Duncan, for your time. Sorry for all of my interruptions on my end. Working from home has its pros and cons, as I'm sure you understand. Where can people contact you if they have more lending questions?
They can find me. They can just search my company's name, Infinite Financial, either infinitefinancialllc.com is our website.
There you go.
Infinite Financial, or they can look up my name, Duncan Hsia. You can look at reviews on Zillow or Yelp or Google, and they can. My phone number is on all those websites. My number is 808-489-1067.
Thank you, and thank you for this smiley face Buddha thing that holds my phone while
awesome, right?
I'm working. I know. I found this the other day, and I forgot that this was good branding because I forgot, and I've been using it recently.
Yeah, we use it all the time, especially now where we can watch all these videos and things. Especially with the baby, we have a lot of videos.
Exactly. Well, thank you, Duncan. I really appreciate your time and doing this last minute, and I'll be in touch with my clients and more questions, and you have a great rest of your day.
My pleasure. You too. Thanks, Ashley.
Aloha.
Aloha.